Izelle is graduated with a BCom Honours in Accounting at the University of South Africa after achieving a BAc LLB degree from the University of Stellenbosch. She started her articles at Shoprite in 2007 and postponed this after 2 years to pursue an African adventure. Upon her return from Tanzania, she resumed and completed her articles. She successfully completed her initial test of competence examination at SAICA and registered as a chartered accountant in March 2016. During her articles, she was involved in a wide range of industries. Izelle's articles at Shoprite exposed her to one of the largest retail companies in South Africa and exposed her to management accounting and reporting, internal audit, tax, and financial reporting. After her articles, she continued to work as a financial accountant for a diamond mine, a helicopter company, a company trust, BBBEE companies, as well as transport companies. So it is my pleasure to hand you over to Izelle.
Thank you, Shane. Let me just put mine off as well. Good morning, Shane, and all the other attendees. Thank you so much for joining us this morning. First off, I'm very excited to present this topic. It's incredibly relevant, I feel, and I hope that I can give you some insight into the starting point in terms of pricing, the concepts, different strategies, and why pricing is vital to the success of any business. In my opinion, this is a very relevant topic, especially in these economic times and in this climate where things are quite tough. 2020 has been a rough year, and one needs to be on the ball in terms of pricing to make all of our businesses work. So as a business owner myself, naturally in the services industry, and being closely involved in my clients' businesses and their costing models and pricing, and to provide insight into the processes that should be followed in order to sell at a profit. Shane, if you wouldn't mind running the poll, please, so that we can get an idea of the industries that our listeners are in at the moment, please.
Okay, I'm going to close the poll on 80% participation, which is absolutely fantastic. And there we have it. We have got 91% of you guys are service providers, 5% retail, only 4% manufacturing. So there we go. Back to you. Thanks, Izelle.
Thank you so much, Shane. I was expecting services, but not so many. All right, so let's begin. As an introduction, I think it's very important to firstly sit down in a quiet space and ask yourself, why am I in business? Are you in business for profit? Are you for job creation, which ultimately contributes to the economy and decreases unemployment? Are you in business for your retirement income, or do you aim to one day sell your business? As we all operate in a capitalist society, we naturally strive to ultimately improve our lifestyles. An interesting way of looking at job creation, though, is for every job you create, you can feed at least 4 mouths. So what do you ultimately want from the successful running and profitability of your business? Did you, for example, know that one of the measurements of success of a small business is whether the owner or the owners can take home a market-related salary, cost to company, and be able to pay that salary in cash every month? Another measurement of success is contributing to the economy in terms of employment and job creation. And it's good if you pay income tax because your business is profitable. I think this is quite a complex topic, as there are a lot of factors that can influence the selling prices of goods as well as services. Today, I want to look into a number of the factors and considerations when costing goods as well as services. Let me first delve into some definitions and concepts as a starting point. Let's look at the different types of profit. So we have gross profit, net profit, and taxable profit. Understanding the difference between the different profits is very important for costing of goods and services, because you need to have a very clear idea of what it is you need to cover in terms of costs in order to make a success of your business. Gross profit is simply the difference between the selling price and the cost price. In, for example, a retail environment where you would buy a tin of baked beans for R2 and sell it for R4, the gross profit is R2. In a manufacturing environment where I think the audience is only 4%, as Shane mentioned, cost price is more complex because you have raw materials, you have work in progress, and you have finished goods now. In a service environment, the cost of sales would probably be salaries and time spent, so billable hours. If we then have a look at net profit, that is the profit you are left with after the running expenses have been covered. So running expenses would be, in my baked beans example, the transport of getting the baked beans to the shop, the rent of the shop where you sell the baked beans from. You would also have to look at the wage or salary that you pay to the cashier and the electricity you consume to keep the lights on in the store. Taxable profit then is often slightly different from your net or accounting profit because tax laws either allow for greater deductions or smaller deductions of expenses. I think the next very important concept we need to look at is defining the business, and you need to create a point of departure. So every business owner needs to actually brainstorm what the business is all about. What is the goal of the business? What the underlying culture of your business is? Which type of structure you'll follow? You need to do some market research on the businesses that are similar in the industry and do some research on market price sensitivity. What we as accountants in the business world refer to is collectively is called a business plan or a financial plan. Now, that usually scares some people, but they don't need to be overly complex. They don't need to take 6 to 12 months to draw up. You know, startups can opt for simpler business models. You need to see it as a roadmap to your success. It's very important to remember that they need to be flexible. What makes a good business plan is that it should be simple, specific, realistic, and complete. Next, we can look at 2 costing models. We either cost from the top down or from the bottom up. And there are different views surrounding that and different reasons for using whichever model. The one method is to determine what the margin needs to be and cost from there. Another method looks at the fixed costs, what is required to cover these, and then adds an amount of profit to the price to arrive at the selling price. One could also use a hybrid model, so you could do the exercise from both sides and then determine what the selling price will be the most favorable. I will go through an example in a few minutes to illustrate the concept, but let me first explain the budgeting structure and why that would be important. So as part of your business and financial plan, you would have to build a budgeting structure. And to build a flexible budgeting structure is very important. We basically are building a profit and loss statement with all the known variables that you have at this point. So I would start to build this structure with the expenses that you need to cover. So start from the bottom up. In other words, you could project for 12 months what your expenses would be. That is the overheads that need to be covered. So these will include items such as marketing, insurance, stationery, rent, electricity and other utilities, salaries and wages, accounting and compliance fees, bank charges, which is sometimes forgotten, software fees, social media retainers, cleaning, legal fees, couriers or motor vehicle expenses, telephone charges, and so forth. You should list every possible expense that will be incurred to result in your product being sold or your service being offered. This will then put you in the position of having a bird's eye view of your expenses or overheads and use these in further calculations for determining selling prices. Now you will be able to see what figure you require to be covered each month by your sales. The second step would then be, of the budgeting structure, would be to estimate your sales or revenues. This will naturally be different for sale of goods versus services offered. In terms of goods, you should ask the following questions. If I want to generate 10,000 rands revenue, how many tins of baked beans do I need to sell? At a 4 rand selling price, I would need to sell 2,500 tins. Now I need to pay my assistant salary of 10,000 and I can bill 500 rand per hour. How many hours would I be required to bill? 20 hours. That would be relevant to the services industry. These are quite simple examples of the way in which you begin to break down the required or desired selling prices. If, for example, you think it may be difficult to sell 2,500 tins of baked beans, you could consider diversifying your products. Sell some hummus. Because of its nature as a luxury item, you may be able to increase your gross profit overall. And therefore, you would need to sell less tins of baked beans. We refer to this as a product mix. Another example would be to sell products online versus in-store to decrease certain overheads. You could cut out distributors or stockists, or you could go to retailers directly. The income required, as discussed, will differ according to the type of business you're running. That is, in terms of goods, you'll be required to determine how many tins of baked beans to sell in order to cover the overheads and still make a profit. Costing services is relatively similar, as you would in the same manner know what the overheads are that you would be required to cover. I will discuss the costing of services a little bit later. The next concept that I know causes some confusion is markup versus margin. It's a question very often asked and they are often misunderstood. Markup is the selling price less the cost price, expressed as a percentage over the cost. So it's the amount by which the cost is increased to arrive at the selling price. In the example on the slide, you would say your baked beans selling price is 4 rand, you pay 2 rand, therefore your markup is 100%. Margin, on the other hand, is the gross profit margin expressed as a percentage of revenue. So therefore, if you look at the example on the slide, the same tin of baked beans sells for 4 rand, you pay 2 rand for it, therefore your margin would be 50%. It's vital to understand the difference because larger retailers refer to and almost exclusively use margin as their point of departure because it represents a mix of products that makes up revenue. The next very important concept would be how to calculate the break-even point. That is dividing your fixed costs by your contribution margin. Now, what is a contribution margin? That would be your selling price minus your variable costs. In other words, what are the fixed costs that need to be covered by my sales as a bare minimum? So therefore, your break-even point in rands would be your fixed costs divided by your contribution margin. Here is an example that we can look at. I have fixed costs of salaries and rent, for instance, of 15,000 rand a month. My baked beans sell for 4 rand and every tin costs me 2 rand. Therefore, my break-even sales will be 15,000 rand divided by 2 rand, which gives me 7,500 tins I need to sell in order to cover my costs. Therefore, if I now need to make a profit, my target sales will be in excess of 7,500 tins sold. If I were, for example, to sell 10,000 tins, I would have a net profit of 5,000 rand. Let's investigate the concept of return on investment and why it would be relevant in this webinar. What does return on investment actually mean? It means, what would I expect as a return on my investment? 20%, 30%, or is 15% sufficient? One needs to be realistic when it comes to the bottom line return. This is actual pre-tax profit after all my expenses have been covered. Let's have a look at margin. And what is a realistic figure? Generally, a figure of 40 to 50% is acceptable for comparable products. This can naturally be much higher if the product or service is unique or if you offer it in a niche market. If we look at an example, if you use a cost plus method or a bottom up method, we would say, this table cost me 400 Rand. If I require a margin of 50%, the selling price should be 800 Rand. Does this 800 Rand then in turn cover the fixed costs as determined by me? How many tables would I be required to sell? That would be my break-even calculation. Always remember that business is high risk. It's not like putting your money in the bank or being an employee. And therefore, the reward should always be higher than putting the money in the bank. But therefore, the risk will be higher. Equity financing will always be more expensive than debt financing because debt is mostly granted at fixed rates. Never ever underestimate the impact that human behavior has on pricing. We can do all our fancy numbers and sums, but humans don't always behave in logical ways as numbers do, and they're not cast in stone and predictable. Let us delve into some detail and examine 7 different pricing strategies and what their impact is, as well as their advantages and disadvantages. If we look, for example, at keystone pricing, it's the first of the 7 methods. It's often used in the retail industry. It sets your retail price for a specific item at twice the amount that you paid. Simple as that. By doubling your cost in this manner, you set your business profit margin at 100%, making the selling price 100% greater than the cost. Keep in mind, however, that keystone pricing doesn't mean that your profit is 100%, only your gross profit. What are the advantages of using keystone pricing? It's very quick. You'll often find keystone pricing at work in the retail clothing industry. So when you sell clothing, accessories, and shoes, you would typically use keystone pricing and mark your wares up 100% at the first of the season. What you don't sell, and if you don't sell these items before they go out of season, you typically have to mark them down 50% or more to get them out of the way for more profitable items in your store. In these instances, keystone pricing lets you profit from the items you sell at full price and cover losses on seasonal markdowns. Additionally, many retailers adjust keystone markups higher for hard-to-get items or lower to stay competitive with other retailers. The disadvantages of using this pricing model is that it can be unreasonably high or too low if it is in a specialized commodity. Retailers can't use keystone pricing on certain items simply because some items just don't sell at twice the amount retailers must pay. Items with smaller markups due to customers who expect low prices and fierce market competition include computers, televisions, and appliances. All these items typically have small profit margins, and some retailers even keep their pricing for these items near the break-even point, so they can possibly convince customers who arrive looking for low-price items to also purchase items with higher profit margins to go along with a new item. Next, we'll have a look at value pricing. One of the many pricing strategies is value pricing, which refers to setting your price based on what customers are willing to pay. The name comes from the idea that the price of a good or service is set at the customer's perceived value of what is being sold. Value pricing doesn't factor in the cost of the product or competitor prices. The goal of value pricing is to set your price as high as possible while driving away a minimal number of customers. So where does value pricing work? It usually applies to a specialized good or service that creates favorable conditions for the customer. Value pricing would probably be used in a service industry, I think, would probably be where it would be used most. And for instance, an athletic clothing manufacturer can charge higher prices for goods if its customers perceive the gear as more beneficial than the other products. Golf drivers designed to carry a golf ball further can be priced higher because of the favorable condition to the customer. Value pricing also applies to industries where customers are very averse to unfavorable conditions. So for instance, one example is the court system, where clients are willing to pay higher prices for lawyers to avoid legal penalties. Therefore, the perceived value of hiring a great specialized lawyer means defense lawyers who take on these cases can charge more. What are the benefits or the advantages of value pricing? Unlike other pricing models, it doesn't force you to charge a price close to the product's cost or what a competitor is charging. That means value pricing gives you more flexibility regarding the product pricing structure. Incorporating value pricing doesn't require research on material costs, labor costs, overhead allocation, or competitor actions. It also has the potential of a greater impact on net income than other pricing strategies. Value pricing overlaps multiple business departments, and it can motivate businesses to offer the best products possible. Because the goal of value pricing is to maximize the value of one product over another, using this strategy tends to help a business develop a higher quality, more useful product. Finally, value pricing places heavy emphasis on customers, and this positively impacts a company's reputation. Companies that use value pricing often employ customer surveys, discussions, interviews, or feedback, which help promote interaction with customers and foster brand loyalty. What is the impact of value pricing on net income? So the success of your pricing model strategy directly impacts your net income. While other pricing strategies limit potential revenue based on expenses or competitors' prices, value pricing gives you unlimited potential on revenue opportunities. Your company's brand recognition, product distinction, and perceived value to customer drive your net income. The effectiveness of value pricing can also depend on the next best product or service on the market. If the closest product or service is very similar to what you offer, value pricing has minimal impact because there's little perceived additional value to the customer. Many customers may spend less on a product that's similar if your product doesn't offer much higher perceived value. Products that are distinct have a greater value pricing impact on net income. Let's have a look at the disadvantages of value pricing. There are two major hurdles of value pricing. It requires an extensive amount of information and research. Value pricing strategies are based off of customer experiences and market conditions. These items can fluctuate constantly, and it's impossible to precisely identify an exact price for use. For this reason, another challenge to value pricing is uncertainty. While the price assigned to a good can be substantiated by research, it's still up for interpretation by customers. How do you implement the strategy? To use it, you first need to offer a unique good or service. So it is only effective if customers can distinguish the increased value of what you offer compared to your competitors. This difference creates the element of perceived value. Communication is key to demonstrate value to customers. Before pursuing value pricing strategies, it's a good idea to evaluate how your product line or service line compares to the market and how to articulate this to potential customers. It's a good idea to anticipate customers' questions regarding your high prices and have answers ready for them. And another important aspect of incorporating value pricing is the lack of a fixed equation model. As an example, a cost plus pricing strategy combines all product expenses and assigns a markup. Value pricing, however, requires a substantial amount of research because each product is different and each industry is treated differently by consumers. Seeking expert advice on value pricing whenever possible helps you learn more about changes in the market approaches and strategies. Any business owner needs to know what his or her competitors are charging for the same product or service. Beating out the competition, as the name of the strategy suggests, comparative pricing refers to using competitive pricing data as a benchmark and consciously pricing your product below theirs. If the products are similar and cannot be differentiated, then the price will have to be more attractive in order to win the sale. If it's a unique product, then it becomes easier to add a margin, but it could become more difficult to sell. Outpricing your competitors can influence price-conscious consumers to purchase your products over similar ones. However, the race to the bottom from a pricing perspective isn't always the best strategy for every business and product. In other words, market research is vital for any business, and this needs to be ongoing. One cannot only do market research once and then never again. What are the advantages of this pricing model? It can prevent your business from losing market share to a competitor. It can also be effective if you can negotiate with your suppliers to obtain a lower cost per unit while cutting costs and actively promoting your special pricing. What are the disadvantages of this model? So when using the competitive pricing model and you set the same price as their competitors who do not necessarily have the same fixed costs, companies can find themselves in a situation where they are making a suboptimal level of profit. This can be difficult to sustain if you're a smaller retailer, for instance. Lower prices mean lower profit margins, and so you'll have to sell higher volumes than competitors. And depending on the product you're selling, customers may not always reach for the lowest price item on the shelf. Retail price is very simple. You use the cost of a product, divide it by 100, less your desired markup, and multiply by 100 to arrive at the selling price. There's an example on the slide. So if you sell, the cost of a product is 40 Rand and you want a 50% markup, you would say your 50 Rand divided by 100 minus 50% times 100 gives us a 80 Rand selling price. This is a very simple method, so the advantage would be that it's not complicated, but the disadvantages would be that it doesn't work for every product or every retailer. The next pricing model, which I think we're all very familiar with, is what we call bundle pricing. And grocery stores often use it, but so do apparel stores. So socks, underwear, t-shirts. With multiple pricing strategies, retailers sell more than one product for a single price, and that is called bundle pricing. The advantages, of course, are that retailers use this strategy to create a higher perceived value. for a lower cost, which can then ultimately lead to driving larger volume purchases. The disadvantages of this model is when you bundle products together for a lower cost, you may have trouble selling them individually at a higher cost, which then leads to creating conflicting beliefs for consumers. Another very interesting pricing strategy is called psychological pricing. Studies have shown that when merchants spend money, they're experiencing pain or loss. So it's up to retailers to help minimize the pain, which can increase the likelihood that customers will make a purchase. Traditionally, merchants have accomplished this with prices ending in an odd number, like 5, 7, or 9. For example, a retailer would price a product at R8.99 instead of R9. William Poundstone wrote a book called Priceless. He picks apart 8 studies on the use of charm prices. So that's what we call these prices ending in odd numbers, and found that they increased sales by 24% on average when compared to the nearby rounded price points. But how do you choose which odd number to use in your pricing strategy? Number 9 reigns when it comes to many retail pricing strategies. There was research done at MIT, and they had a woman's item of clothing priced at 34 Rand, 39 Rand, and 44 Rand. Guess which one sold the most? What are the advantages of charm pricing? It allows retailers to trigger impulse purchasing. Ending prices with an odd number gives shoppers the perception that they're getting a deal and that they can be tough to resist. What are the disadvantages? When you're selling luxury goods like tablets, etc., iPads, lowering your prices from, say, 10,000 to 9,999 could hurt your brand's reputation, because it can give luxury customers the impression that the products are defective or are marked down for a similar reason. Let's have a look at penetration pricing and discount pricing. It's no secret that all of us shoppers love sales and rebates and seasonal pricing and other markdowns. That's why discounting is a top pricing method for retailers across all sectors. Used by 90% of survey respondents in a study done from Software Advice, there are several benefits to leaning on discount pricing. The more apparent ones include increasing foot traffic in your store, if you have one, offloading unsold inventory, and attracting a more price-conscious group of customers. The advantages of discount pricing would be that it's very effective for attracting a large amount of foot traffic and to get rid of out-of-season inventory. The disadvantages of this model is that if used too often, it could give you a reputation of being a bargain retailer and could hinder consumers from purchasing your products for regular prices. Penetration pricing is also a marketing strategy that's useful for new brands. So essentially, a lower price is temporarily used to introduce a new product in order to gain market share. The trade-off of additional profit for customer awareness is one many new brands are willing to make in order to get their foot in the door. In my next slide, I would like to discuss a very relevant topic, as there are a lot of handmade products out there. And where on earth would you start? How do you know how to price what you're making? Because now the internet is a very friendly place for artisan entrepreneurs, with many e-commerce platforms such as Shopify, Takealot, that are actually welcoming handmade sellers. So now you've created your own product, and you have registered on your online shop, and now you need to add your products. But when you start adding those products, how do you price them? So you need to make sure that pricing your handmade products will keep your business sustainable. Firstly, as a point of departure, you would look at your material costs. So you would calculate the cost of all the materials you use. You need to include the costs of any packaging. For example, if you make teapots, you would then need to include the packaging that you wrap them in, your customized tissue paper. If you put a branded sticker on, you tie it with a ribbon, the box that you would package it in. You need to account for all those materials. For instance, if you ship your coffee cups in bubble wrap, you need to make sure that you take all those costs into account. The next very important thing to keep in mind is the time that you've spent on making your cup and your teapot and your earring, because undervaluing your time is the biggest mistake an artisan seller can make. You may find that it costs you 30 Rand to craft a cup or a mug and prepare it for shipping, price it at 40 Rand and make a profit and call it a day. However, you've worked for, say, 30 minutes on preparing it. I'm sure that's quite a bit longer, but let's use that as an example. And now you've only made 10 Rand for a half an hour's work. You need to also take into account that you are spending time in marketing and communicating with potential customers. With profit margins too low, it's hard to make enough money to keep operating the business. I quickly want to look at an example. If your clay, your paint and your sealant cost you 30 Rand, and you would say, well, it's 200 Rand an hour, I would think, for a certain expertise, and you would go for 100% markup. You would then take your cost of your product plus your half an hour's time and multiply it with your markup. So you should then sell that for 260 Rand. I think my audience is mostly in the services industry, so let's delve into the pricing of services. And I think that the easiest way to do that is to follow these 6 steps. You see, there's not a set in stone method for pricing services because you need to be flexible as well. Let's have a look. You would first calculate your costs. You would look at the market. You need to know your customers. You need to consider your time invested. You need to come up with a fair profit margin. And then you need to either charge an hourly or a per project rate. So calculating your costs. You would need to know how much it costs to provide your services. To do so, you use cost-based pricing. Cost-based pricing is when businesses add up the costs that go into making a product or providing a service and mark up their prices from there. So as a service-based business, your costs are going to be a little different from that of a product-based business. You are not stocking up in inventory, but you still spend money to operate your business, I think, which we all often forget. Understanding the true costs of providing your service plays a big part in learning how to price your services. You can break down your costs into 2 categories: direct costs and indirect costs. You add together both of those to determine the total amount of money you must cover during a time period. A tip: if you know your costs, it's a starting point for service pricing. Remember, you must make at least your costs to reach your break-even point. So what would be your direct costs? They are expenses that go directly into providing your services. So that would be direct labor or direct materials. Indirect costs are expenses that you need to run your business but can't pinpoint to a specific project. So you need to pay special attention to your overhead expenses, which are a type of indirect costs. That would be the rent of your office, professional subscriptions to controlling bodies is often overlooked because it's a once a year charge, personal indemnity insurances, that all needs to be taken into account. Any utilities that you would be paying, your computer, you need to replace that every now and then. Other insurances you might pay if you have a receptionist, if you're doing marketing and advertising. Those are all indirect costs that you need to take into account. Secondly, you would then look at the market. So what are your competitors charging for similar services? How's the market itself holding up? Under market-based pricing, businesses look at what competitors are charging for similar products or services. On its own, using market-based pricing generally isn't sustainable. You shouldn't base your pricing for services solely on what competitors are doing, but be aware of what other companies charge so that your prices aren't completely off base. Your competitors are playing in the same arena. Ignoring the strategies for pricing services doesn't help you break the mold in the industry. Instead, it leaves you ignorant about what's happening in your market, and you need to know how the market is doing before setting a price that nobody can afford. A tip is keeping an eye on competitor pricing reveals what sets you apart. If you charge more than your competition, you need to show your customers the value of the unique experience that your company offers. The third one would be to know your customers, and you need to know your perceived value. So no matter how much you charge, you won't make any money if customers are not willing to pay. You need to understand how customers perceive your business. And to do that, you need to know your customers. Get close to your customers. You could use a market study to collect information about your target customers. Find out how much your customers are willing to pay. Look at things like their needs, their income, their family status, their occupations. One could distribute surveys, conduct focus groups to find out how much customers would be willing to pay for your services. Learning more information about your customers is part of a value-based pricing strategy. Under this strategy, a business bases its service prices on how much consumers value the offerings. Let us look at considering your time invested. So looking at your costs, competitors and businesses value aren't your only considerations when you price your services. The time you put into your business matters as well. Think about how much time you invest in providing services. The longer you spend on a project, the more you should earn. You need to track how long it takes you to complete a project to help you come up with a fair price. You also need to consider how long you've been in the industry. The more time you have under your belt, the more value you add to your company and thus the offerings you provide. Generally, you can charge more as an experienced, trusted, and reputable individual in your industry. A tip: you pouring time into providing a service usually translates to the customer saving their time. So don't forget to consider your valuable time when coming up with a strategy and marketing how much valuable time you'll save your customers. Then you need to decide on a fair profit margin. Coming up with a fair margin is key to turning a profit. Firstly, you need to decide what percentage you want the profit margin to be. Profit margins generally vary by industry, but a 10% profit margin is typically average. If you want to know how to determine pricing for a service, add together your total costs and multiply it by your desired profit percentage. Then add the amount of your costs. We'll look at an example in a second. A tip is to consider your costs, the market, your perceived value, and time invested to come up with a fair profit margin. Now, we need to be able to charge an hourly or a per project rate. So finally, you need to decide whether you'll charge customers an hourly or a per project rate. You might consider charging customers by the project if you're confident in the amount of time you think it'll take you. Or you might charge hourly if you don't know how much time it'll take you to perform the service. Whether you charge customers per hour or project may depend on your industry. For example, a psychologist may charge per hour, whereas a lawn service may charge per project. If we look at an example. So billing customers an hourly rate is quite a popular strategy for pricing services. But to do so, you need to find out the number of hours you will log during a year. So a typical working week is 40 hours multiplied by 52 weeks gives you 2,080 hours a year. But you surely need to take some holiday, family leave, sick leave, so you need to plan for that. So from that, you subtract your, say it's a 15 days leave. So from the 2,080, you would subtract that. And you will find the actual amount of hours worked. Once you've determined that, you can plan on working for the year, find your billable hours. So you subtract your non-billable time from your total hours. This will include tasks that don't directly generate revenue, like sourcing clients, marketing, filling out paperwork, filing, administration. So deduct the number of hours you devote to non-billable tasks. That depends on business to business. Then you will divide your expenses by your billable hours to find out how much you need to charge per hour to cover your expenses. So in other words, you will then work out your hourly rate to break even. You need to naturally factor in a profit margin because you want your business to grow. And let's quickly look at this example. All right, so your annual cost of your business is 120,000 Rand a year, and you plan on working 1,960 hours, of which 20% will be non-billable. Therefore, you have 1,568 billable hours. You'll take your fixed costs divided by that, which then gives you 77 Rand an hour. Add your profit margin, and you would come to 89 Rand an hour. Obviously, you can decide on a higher profit margin if you think that is relevant. If we quickly look at a per project rate, so you might opt then for charging your customers by the project rather than by the hour. So to come up with a per project rate, you could use your hourly rate and estimate how long it would take you to perform the service. You could charge a fixed price for each service. So if you decide to use your hourly rate to determine your per project rate, you just multiply your time you think you'll take by your hourly rate. To charge a fixed price for each service, factor in your costs and market your value, time, and profit margin before you come up with a rate. So for example, a 50-hour project multiplied by 89 Rand an hour would then be 4,450. What's your fair price? There isn't one way to approach the pricing of services, unfortunately. It's up to you to decide what your offerings are worth and how they fit into the market that you serve. If you're calculating prices for the first time, you might think that the amount you're charging is too high. But it's important to know how to calculate profitability accurately so that your business can thrive. If you do a good job and take care of your customers, you shouldn't have a problem with your fees. Deciding on a target profit margin is a very careful balance. You want to mark your prices high enough to earn a good profit margin, but you also must avoid getting a reputation for overcharging. Consumers are very smart. Most are willing to pay a fair price for a good service, but it doesn't take long for customers to figure out if they're getting ripped off. You need to know your worth and choose a service pricing strategy that matches the value of your offerings. I want to leave you with these two quotes, which I think is very relevant, because you need to be happy in your business. And always remember that you need to run a business with the knowledge that you're required to run it with. Sit and do your strategies and your plans. You need to follow the building blocks, as I started off with, and not flying blind. I truly hope that this session has been helpful in laying out some of the basic terms and giving everyone as business owners an idea into the strategies and basics of pricing products and services. So thank you so much for joining us today.
Nice feedback from Johan. Thank you. Great webinar. Thanks. Very useful info and well presented. Thoroughly enjoyed it. Hey, thanks, Johan. Thanks for joining us.
The book's name is Priceless, and the author is William Poundstone.
Hi,
Here we go.
Shane.
Hello, Sharon.
Hi, yes.
Hello, James.
Hi there. Hi, Izelle, and hi, Shane. Thank you very much for the webinar. I've just written to info@ban.co.za, and I'm looking for an accountant that can help. I come more from a very a technology background, and one of the things that I really need to understand, I understand cryptocurrencies a lot, and I just want to know if there is somebody at BAN that can help navigate this, because I literally see cryptocurrencies. There's currently 3,000 cryptocurrencies, and they expect only 5 fiscal currencies to be left by 2040. So I just want to know what your thinking around that is, and who I can connect with at BAN that is doing the investigation around that, please.
All right, cool. Thank you for that, James. Have you got any comments on that, Izelle?
Yes, I think what he's done is perfect, to send an email to Jenna. There are a few of the BAN franchisees I know that are involved with cryptos, so they'll definitely put James in contact with the right person.
Put up a question from Michael. Thanks for sending this through.
Yes, Michael. I think in the end of the day, thanks for the question. It's actually very interesting, and it has a lot to do with our pricing as well, because you would have different levels of expertise. People that do payroll processing or data capture or compile financials is naturally different to people that are doing the other job. So I think what's important, though, it would be the size of your business, and then what the market is doing, right? So I think in this specific question, you would have to do your market research and see what your competitors are doing in order to have a good pricing strategy, that you don't outprice yourself. So
thanks, everybody. Thanks, Izelle, for a fantastic presentation. Thanks, Jenna and Monique, and thank you all for participating. Look forward to welcoming you online again soon. Enjoy the rest of your day. Take care.
thank you, Shane.
Thanks, guys. Bye-bye.